Good afternoon, everybody. It's Tom Bradley. I'm the president of Steadyhand Investment Funds, and welcome to our Steadyhand webcast. Now, before I go any further, I just want to highlight the fact that you can ask questions. If you go to the top right corner of your screen, there's a little chat function, and that's how we're going to do the questions today. So if you have them, we'll sort of accumulate them. Scott Ronalds is here with me, and we'll get to as many as we can at the end. So we're reporting from our office in Vancouver today. Some of you won't want to hear this, but it's a beautiful spring-like day. Our garden's in full bloom, and we're going to take about 25 minutes today, and there's three main topics. Quickly, we'll review the firm and give you a little bit of a feel for how we're doing, Steadyhand. We'll spend a little more time on the year that was, 2015, and then we'll spend a bulk of our time sort of looking forward. What's going on out there, what's our interpretation of it, and how we're approaching it. So let's first start with a little bit of a review on the company. And last year was a real hallmark year for us. It was a year when we crossed through $500 million, and a big thanks goes out to all of you. You know, our clients are at what makes us exist, and we're just delighted with the progress we've made and the growth we're experiencing. And it really has come overwhelmingly from client referrals, referring their friends and family and neighbors, etc. So a big thank you goes out to all of you. Our team has been very stable. Hopefully all of you know at least one or two or three of those people on the screen here. And it's an employee-owned firm, so that's part of what you get when you're shareholders in the actual firm. And one of the ways we show our commitment is by investing alongside you, the clients. And this number, 89%, represents, on average, how much of our financial assets are invested in the Steadyhand funds alongside yourself. So we call it eat your own cooking. We think it's a very concrete way of showing our commitment to what we do for you. So in general, I think if I had to wrap up on the firm, I'd say it's more of the same. I mean, we are a sponge for feedback. We'd love to hear more from you. We're trying to tweak things, whether it's our statement or our website, etc. But we like our model. We think our clients like it. We can deliver returns using the way we're structured, and so that's our focus going forward. So now let's take a look at the year that was, 2015, and it really was a wow year. There was a lot going on. It was very volatile, and let me give you a feel and just run through a few charts to sort of set the stage here. First of all, in the commodity arena, everything was down, whether it was metals or it was agriculture commodities, all the rest, including oil, which was the biggie, and we all know the story here, how far oil has gone down. If we look around the world, emerging markets, these are stock markets in developing countries like in Asia and South America, very weak market there. Our market looked very much like a developing market, and I guess with that reliance on resources, that's understandable, but the Canadian market was down a little over 8%. The U.S. market, which has been really the stalwart over the last 5 years, it's been the best market in the world, you can see was decidedly flat last year with a lot of volatility along the way. So it didn't hurt anybody, but it didn't help like it had in previous years. And the final down chart I'll barrage you with is one that actually had a positive impact on your returns, and that's our exchange rate. So this is our dollar versus the U.S. dollar. We all know this very well. But you might wonder, why did that have a positive impact on returns? And let me give you a very concrete example. So if we look at the stock returns from the three major regions of the world, Japan, U.S., and Europe, as well as Canada, you can see nothing to write home about. Japan had a pretty good year at 10%, but U.S. and Europe not so much. But when you convert those returns in the foreign lands back to Canadian dollars, you can see the impact of our weak loonie. So the fact that the yen, the greenback, and the euro were strong against our dollar had a significant impact on the valuation of those assets we held offshore. And it was outside of the sort of the downdrafts I showed you and all those down arrows, this was the second most kind of important feature of the year last year. Currency played a huge impact in returns. So let's translate that into how Steadyhand did, and I'm going to use the Founders Fund today to give you a feel for how we've performed for you. This is the one-year performance for the Founders Fund, and you can see it was just under 4% at 3.9. This is after all fees, and so some of you who've been with us more than 5 years, or perhaps have more than $100,000 with us, the number would probably be in the 4 to 4.5% range. As I'm going to talk about in a minute, it's really driven by how our managers did with the underlying funds, but you can see on the index returns there, you can see the world index up almost 19%. That loonie effect that we just talked about had a big impact, and I will say that last year, and as in previous years, the fund was very well positioned for this. We held more foreign stocks than Canadian stocks, and the returns benefited from that. As we look farther out, this fund has been in existence just about 4 years now, but this number here is 3 years plus 3 quarters, and that 8.5% per year equivalent is, again, after fees. So if you looked at the returns of the environment we were operating in, and you indexed a sort of a Canadian bond and stock portfolio, your returns might be in the neighborhood of 4%. So the 8.5 reflects some good performance from the managers. They all took turns kind of leading the way, but also that foreign factor that we talked about and being positioned for that. Now, as we look at the fund at the end of the year, here was the makeup of it. It's the 5 underlying funds make up the Founders Fund, and I left the logos of the managers on this slide so that you remember that they're the ones that drive the performance here. It is, I certainly have some impact in how I allocate capital to each of the funds, which is my role, but Connor Clark and Lund, CGOV, Edinburgh Partners, and Witherich are what drives returns day to day. And we don't have time today to dig into all of those funds, but I would encourage you, over the next week or two, we're going to publish a report called How Have Steadyhanders Done, and it will drill into each of the funds, the good, the bad, and how we've done, so I'd encourage you to look for that. Now, one of the things that we're really proud of in our 9 years of existence is that our clients have been awesome at staying on track. And if you look at this chart, this is the U.S. market as represented by the S&P 500. You can see going back to the beginning of 2009, it's been a wonderful period for stocks up until really the last few months. But if you look at that and you sort of do a little more analysis, you can see that every year over those 6 years, there was a bit of a pullback. In some cases, even you'd call it a meltdown. 2011, October 2011, down 19%. The point being really here that as long-term investors, this is part of the game. And so here we've had this wonderful stretch of returns, and yet each year there was some bump along the way. And obviously I want to acknowledge how this year has started. It's been a tough year. It's very volatile right now. We've had a little bit of recovery more lately, but we probably could put our 2016 circle on this chart just from the first month and a half that we've had. But our clients have been awesome on this regard, as I said. We just don't see behaviors of, buying at the top, selling at the bottom, trading a lot. All of you have been really great that way. So let's look at the Founders Fund a little differently. I've given you the makeup of how it was constructed using the funds, but let's drill through those funds and look at its asset mix and the actual asset categories that they hold. So this is the long-term target of the fund. We liken it to what we call a 60-40 fund, and all that means is that our target sort of notionally is 60% stocks, 40% fixed income, with most of that being bonds. Now, at the end of the year, it didn't look quite like that, and that's because I, and with assistance of Salman, made some adjustments, and these have been pretty typical for the almost 4-year history of the fund. But at the top of this bar chart, you can see there's more green than red. We've had a tilt towards foreign stocks as opposed to Canadian, and as you've seen, that's been a benefit. And on the bottom, we just haven't felt comfortable with the risks in the bond market as awesome a job as Connor Clark and Lund have done, so we've been holding cash, and indeed for the kinds of times that we're facing right now, having that cash available to put to work. The biggest feature here, I guess, is that, and this chart really doesn't tell you this, but this has changed. So this is December 31st, but if you went back to last summer, maybe July, and you were sitting on your deck or your dock and you were reading your quarterly report, I know you all do that, you would have seen that we were still pretty cautious, and we had about 55% stocks in the Founders Fund. Late summer, it was a very weak market. Early September, we did some buying to bring it up to about where you see it here on the chart for year-end, around 60%. But since the middle of January, we've been pretty steadily buying stocks, using weekdays to just incrementally move up the stock weighting. So we're now at 66%, and that cash level is down under 10. I think it's about 9. So you might be wondering, geez, the world's melting down out there. The market's been weak. What the heck is Tom doing with buying stocks? And that's really the next part of the presentation, is to talk about why we're doing that and look forward. And so, trying to keep things simple in my mind, I look at it with sort of through three lenses. The fundamentals, which is a huge area, economies, currencies, interest rates, oil prices, etc. Then valuation, how are we valuing those fundamentals? And then finally, the market's mood or investor sentiment. And I'm going to touch on all three of those as we go through today. So let's start with fundamentals. And the overwhelming theme in the world out there today is that it's slowing down or is already operating at a pretty slow growth rate. This is a busy street in China that if you took that picture again today, it wouldn't be as busy, because one of the parts of the world that's really spooking the markets is that China is slowing down. So if we look at China's annual growth rate, and this is a bar chart that goes back to 2000. Each of these represents the amount of growth that they had in the economy, and it's a remarkable chart. 2014, China, economy the size of China grew 14%. But I guess one of the messages here is that it has been trending down. Last year was just slightly under 7%. And if you do the analysis, and Salman and I have seen a number of different ways of slicing and dicing it, there's a pretty strong belief out there that the number really wasn't 6.9, it was quite a bit weaker than that. So the growth in China is perceptibly slowing, but I think the other thing to take note of here is that the quality of that growth has really deteriorated, and in a couple of ways. One is that, while it's still an exporting manufacturing machine, there is no growth in that part of the economy, so all of the growth has been coming from government subsidies, building roads, airports, bridges, and also using a lot of debt. So if we look at this next chart, you'll see that China, this is a measure commonly used to sort of compare countries. This is total debt as a percentage of the economy. It was at about 160%, kind of flatlining there until the crisis, and has steadily gone up, dare I say rocketing up, to 240, and such that China is now a full-fledged member of the Western World's Debt Club. It's right in there with all the rest of us. But what's concerning is that it's gone up very fast. There's not a lot of transparency into the debt markets there, so we don't know if this number could even be worse. And so the markets are definitely spooked today. It's not that China is the be-all and end-all of growth, but it has been one of the engines of world growth over the last decade, and so there's a real concern. Now that debt is going to serve not only to add to the risk that something happens in China, but also that it slows down the growth. It just puts a brake on growth. And we're not an exception to that. You've seen this chart before, I think, but this is, if we look at Canada, the amount of debt as a percentage of disposable income, this is a consumer debt measure. You can see that after tracking the U.S. pretty closely for many, many years, we broke away after the crisis. The U.S. consumer retrenched, had a terrible housing market, and is now in very good shape. But we've continued to increase our debt levels through mortgage debt, home equity loans, lines of credit, credit cards, car loans, etc. So it is something that absolutely puts the brake on future growth. And I think the overall view from our shop and from Connor Clark and Lund, one of our managers, is that we are in a much slower growth mode. Now I'm showing you an interest rate chart here, and one of the reasons I am is because there's a consequence to that slow growth and too much debt, and that is that rates are likely to stay lower longer. And I'm first to admit this has surprised me how long this has gone on, but you can see here we've circled 1.1%. If you wanted to lend the Government of Canada money for 10 years today, you get a whole 1.1% for doing that per year, and then you get your money back at the end. So rates are very low. There's certainly a risk they go up because inflation is above 1.1%, but that's the first conclusion sort of comes from those charts I've shown you, is that, and certainly our income manager, Connor Clark and Len, is of the view that maybe not this low, but in that low range going forward is very much a reality. Now, when you logged on today, something else besides China that was probably on your mind was oil and the Canadian dollar. And here you can see just a different version of the oil price than we showed you earlier. And if you lay over the Canadian dollar, it's got a remarkable similarity, doesn't it? It looks like it's tracking it. And certainly over the last couple of years, it's felt like that, certainly sitting, Scott and I sitting here watching the screen and seeing a day when the oil's down, our dollar seems to be down. So the point number one here is when we get a recovery in oil, and we do think that will come, it's not sustainable at these kind of levels, we should get some recovery in our dollar. But I guess the second point we want to make here is that it isn't that simple. There's a lot more going on with our currency beyond just the resources and oil specifically. For one thing, the Canadian dollar at par was not sustainable. And we weren't a productive enough economy, strong enough economy to justify that par value, and so this decline is partly a result of that as we find ourselves here today. But as we look at Canada and oil, I think we have to have some perspective, and we drew up this chart really to sort of represent the stocks in the Founders Fund as an example, but it could be any Steadyhand portfolio. And the big broad circle is all of the stocks in the portfolio, and there's some representative names there like Panasonic and Novartis and Unilever. The smaller blue circle is the stocks that are based in Canada and trade in Toronto, so Canadian stocks. So Franco, McDonald Detweiler, Suncor would be examples of that. But we took it a level further and we said, of those companies, how many are really dependent on the Canadian economy? And we came up with a number of around 25%, although I think that's generous. It's probably a little bit lower than that. So Home Capital, a mortgage lender, for sure is dependent on the Canadian consumer. A grocer, Loblaws, TD Bank, has a big U.S. operation, but is driven by what happens in Canada. So I think the point here is just that as much as the headlines that impact Canada we read about every day and all the doom and gloom, but also maybe impacts a Starbucks or an Apache or a Microsoft. Our portfolio is much broader than just what's happening and what the Trudeau government is doing here, and I think we have to keep that in mind. So as we sort of wrap up this part of the analysis, fundamentals, it sure sounds negative, doesn't it? And debt burden, China slowing, profit margins I didn't talk about, but maybe deteriorating. But I think it's important to know that there's real cross currents out there, and there's lots of positives too. Oil is very negative for Alberta and Saskatchewan for sure, but for the rest of the world, most of the rest of the world, it's a huge subsidy. It's like a tax cut. Japan, Asia, most of Europe don't produce oil. This is a wonderful, wonderful benefit, and it's just starting to seep into the economic growth. We have very accommodating bankers these days. And I think maybe offsetting the China slowing is this huge economic entity called Europe, which has been on its back for going on 6 or 7 years, which is starting to gurgle up. And we talked to our managers, particularly Edinburgh Borough Partners based in Scotland, and they see that. There is growth. There's good auto sales. There's reasonable retail sales now in Europe. It is starting to come off its back. So really, in conclusion, we just don't feel we want to make a bet going to the negative side or the positive side based on the fundamentals. It isn't that simple. I will say, though, that the headlines out there are more negative than we are. We think there's, as you see on the right side of this teeter-totter, there is absolutely some positives that aren't getting shown through as we read all the doom and gloom in the paper. So let's move on to something that we are a little more certain about than that fundamental outlook, and that is valuation. And I guess where we find ourselves today, and it's the reason we've done so much buying, is that valuations in general for risk assets have got much better. So compared to 1, 2, 3, even 4 years ago, we are getting paid more as investors to take risk in the markets. And I've got a couple of examples to show you. First of all, in the fixed income market, this is a chart represents the overall high-yield bond market in the U.S., and this is the yield tracking back to 2011. So high yield is sometimes known as junk bonds. They're lower quality bonds. They require a higher yield for somebody to buy them. But you can see where we were about a year ago. The high yield market was trading at 6%. So there's some risk here when you buy these kinds of things, and you were getting paid about 6% to take that. Not enough in our view. We didn't own any junk bonds at that point, but we're now at 10%. In fact, we're a little north of 10%. So once again, high yield, and it may go higher, and that will impact the prices of these bonds, but clearly we're getting treated a little bit better when we want to take risk in the high yield market. Now, as we move along to stocks, this is a chart some of you have seen me use before. This is the price to earnings multiple of the overall market. It's actually the Value Line Research Service, about 1,700 stocks. And, you know, it bounces around from time to time. The long-term average post-inflation is about 16. Last year at this time when we were doing our cross-country tour, we were up at around 19, and I was pretty cautious. I felt valuations were a little stretched. But suffice to say, with the weakness in the markets, both in the summer and then again recently, these valuations have come right back to about average. Now, they're not way below the line. We're not jumping all over the table, but we're finding our managers are again finding lots of cheap stocks to buy. It's not universal. Will Witheridge said to us the other day, you've still got to be selective. It's not like shooting fish in a barrel, but it is very much, valuations is again a positive on our checklist. Now finally, talking about investor sentiment, and not all firms talk about this, but this is something I learned from Bob Hager and Art Phillips, who I trained under years ago. And really it boils down to what Warren Buffett characterizes at best when he says, we simply attempt to be fearful when others are greedy and be greedy only when others are fearful. So what this is called, investor sentiment is what we call a contrarian indicator. When everybody's bullish, Warren, Art Phillips, myself, get cautious, and vice versa. When everybody's down in the dumps, it's usually a time to get more positive and start to do some buying. And if we go to the next slide, you'll see that this is anecdotal, but this went around the world, went viral about a month ago now, this sell everything headline, and it emanated out of a report that was done by the Royal Bank of Scotland. Salman and I read it. It was a 55-page report. It was pretty gloomy. China, China slowing down, too much debt, all the things we've talked about. But it got capsulized into 2 words, sell everything. And it really, my point here is that the markets are, and investors are very fearful today. So we very much are on over to one extreme. We look at also some other indicators that assess individual investors, traders, portfolio managers. Those measures are all kicked over to being the very bearish side. So fundamentals, mixed, certainly not all bad. Valuation, very good. And sentiment, excellent for investing. And that really, when you boil that down to it, has led us to do the buying we've done in the market. Now, just to pull it together, if we look at our expectations over the next 5 years, you won't be surprised by this, but you know, in the fixed income arena, there isn't a lot of return to be had. I think Connor Clark and Lund can do some good things with credit and high yield bonds, et cetera, but they're playing in a sandbox that's going to provide, you know, 0 to 3%. On the stock side, though, with the declines we've had, we've moved this number up. Last summer, I was referring to you sitting on your dock reading the quarterly report. This range was 4 to 6. We thought that, and frankly, it was low enough that you had to ask yourself, do you want to take risk in equities? But we're right back up to really where the long-term range is. I mean, equities have delivered 8 or 9 per year over decades and centuries, and we're right back in that mode. So as we build portfolios for clients, and specifically the Founders Fund, keep these things in mind. This is why we've gone to an overexposure to stocks as compared to where we were a year ago. So let me be a little more specific as we wrap up and speak to two halves of our listeners today. First, I'm going to start with the de-accumulators, which is a very diplomatic way of saying the older crew out there, people that are drawing money out of their portfolio. The first, these are just some observations we have. One is that we find that our retired clients too often don't look at the whole picture. They don't look at the money that's at the credit union, the money they've got with their nephew and the broker, and then the Steadyhand money, and put it all together, because I think you want to make sure that your SAM, or what we call strategic asset mix, makes sense for you. And we're absolutely willing to help you look at all of that. We don't want the other money, but we can help you build a portfolio at Steadyhand that makes sense given all of the assets you have. The second one may be obvious, diversify, but you know, for retireds quite often who want the income, diversification is owning 4 banks instead of 2. And we don't, you know, from reading our stuff, you know, we don't believe in that. Diversification means Canada, U.S., international. It means small, medium, large. It means financials, utilities, consumer, industrial. You need to have a full array of stocks in your portfolio. We're a big believer of that. And then finally, some of you who've whether you've worked with us or not, have kind of money set aside in a spending reserve so that you can leave your longer-term money alone when markets are weak. Well, you guessed it. Now's the time to use your spending reserve. There's nothing wrong with drawing it down instead of selling some of the Founders Fund or the Equity Fund or even the Income Fund. Now's the time to use the spending reserve and bring those down as we work our way through these bumpy markets. Now, the message with the accumulators, and these are those of you that are putting money into your RSP and your TFSAs, making regular contributions, and are ways away from drawing on your portfolio. And the message is very positive here. I mean, we say it every year, but if you can do as much as you can, as early as you can, that's awesome. You want to benefit from the power of compounding. Regular contributions are an excellent way to do it. We have many clients on our pre-authorized contribution list. You too need to diversify, even if it is a much more growthy portfolio. We're not forgetful of the housing market we have in Canada and the demands many of you have on your finances. So we like to think of managing your portfolio in conjunction with managing your debt, and we're happy to weigh in on that if you have questions. But really the theme here for the accumulators is this is an awesome time to be a buyer of assets, and we encourage you not to miss this RSP season. If you've been a regular contributor to RSPs, TFSAs, keep doing it. And if you have a little extra around, we'd encourage you to do it. We don't know when the markets are going to bottom. Those fundamentals, the valuation, the sentiment tells us it's a pretty good time to invest. It could get worse, but it is certainly more attractive than it's been in a number of years, and we just hate to see our clients kind of blink at a time when the opportunities are good. So I'm going to stop there, and I think we've accumulated some questions. So I've got Scotty with me here, and before I go, in case some of you have to drop away, thank you for attending. We'd love your feedback on this. We haven't done a webinar since about 2009, and we've been having a few people push us to do it. So I think we will do more of them, but we'd love your feedback as we assess this afterwards.
Tom, we've got a couple of questions here. The first one, how high in stocks would you go in the Founders Fund?
So as I said, the Founders Fund is the long-term target of it is about 60%, and when we design your portfolios using the Founders Fund, that's the number we use. We're at 66 currently. We've left ourselves a little bit of room. I think it would be unusual if we went past 70, and it would have to be a pretty messy market and the valuations would have to just be screaming off the chart there. But so we've left ourselves a little room with both the managers to take up their weighting and us to put a little more cash to work. But I think probably maximum, with a few exceptions, would be 70.
Second question here, when was the last time you saw sentiment at these levels?
Oh boy, I think probably we are at kind of 2011 levels. I think those of you that have been following along, you saw that chart, the S&P 500 chart that showed the circles, and that the biggest sort of pullback in the market was in 2011. 19%, and it was pretty ugly then. You remember that was when the U.S. government was downgraded. People really thought that maybe we had another 08 brewing, and so I think this is kind of like 2011. I'd hate to liken it to 08, 09, because I think that was a whole different kettle of fish. We had a banking crisis. We didn't even know the whole system was going to keep working, and it was a very scary time, but so something like that.
And one last question here, Tom. The Founders Fund slide seemed to show only 15 holdings. Do you have more?
Yeah, and I apologize. That circle showed was just a representative sample. The Founders Fund would own, in the 3 equity funds, would own about 75 stocks. I'm going to say there might be a couple that are at overlap between funds. And then the income fund owns about another 30 or so. So, you know, we're probably in the range of 105 to 110 stocks in total in the Founders Fund. And as I you know, really want to emphasize, it's very diversified across industries, geographies, currencies, and that's the way we like it.
Well, let's wrap it up there. Thanks to everyone for joining us.
Thank you, and we'll look forward to doing it again. Bye-bye.